And so today we are going to be covering equity. They call it corporate reporting and analysis. We're really talking about equity here. And so big concepts, you can read this yourself, but corporations can fund themselves in two ways. We've learned about this, right? What are the two ways? Debt and equity. Equity can be increased by gaining more partners or shareholders or through your operations. And debt can increase by taking debt, by borrowing money. That's business. And that's why accounting schools, now we really understand that everything a business has is either by borrowing money, you get it through borrowing money, or through your operations, or bringing on partners who bring in money into the business, like selling, which is selling stock. Bringing on partners is selling stock. And so there's a lot of different corporate structures we can make that have this different idea of partnership. And the reason those were made legally was so capital could be raised more efficiently and those investors could be protected. So if you think about it from a high level, if I wanted to bring on all of you, what if I told all my students, that'd be unethical, I'm not telling you to do this, but if I was to say to all of you, I have a great business venture and I want to raise some money. And so I'll sell you some stock, or I'll bring you all on as partners to my business. And you all sign agreements with me saying you're partners. That'd get very complex very quickly, and I would have a lot of legal liability. If I brought on 20, 30, 40 partners into a business, if one of you went and misrepresented some information, I could be held liable as your partner. If I did something unethical, you could be held liable. If one of your businesses go under, or if you go under, I might have to pay for some of your losses. I might have to sell my home, right? This is a hard legal structure, the partnership. And so the government, and based off of law, we've created many other structures, legal structures that businesses can be formed in order to protect against certain risks. So when we're looking at corporations, you can bring on shareholders, right? Investors who actually own part of the business. But then if something wrong happens in the business, that shareholder isn't liable, right? Like I can buy stock in Apple, and then if Apple gets sued, I'm not liable for Apple's lawsuit. I just might lose some money in my investment, in my stock, right? And so these are corporate structures, but businesses can raise money, raise funding, so they can buy assets and improve their business. So that's the whole concept and what we're focusing on today. That's why equity accounting is important. And so let's talk about corporations themselves. And I'll pause for the questions in between. So corporations themselves are an entity created by law. So I created a corporation when I built my recording studio when I was 18, like 12, 13, 14 years ago. And to do that, you actually file paperwork called like a C Corp, an Articles of Incorporation, and you file it, it becomes a legal person. So I write a document, I sign a document that states that my business is now a legal entity. It's a legal entity that exists separate from my owners, right? So I could own this entity and then sell it to Jeremy. I could go hey, Jeremy, you want my recording studio? And he could purchase the legal right to my recording studio, and I no longer own it, right? It's separate from myself. And that corporation has rights and privileges, right? That I could go take that corporation, I could make it go bankrupt. I could have the corporation borrow money, and then I don't owe that money, right? That corporation can borrow money. It's its own person. It's its own identity. And you'll learn a lot more about this in business law. But what's interesting about this is ownership can be privately held or publicly held. And that's when you hear about startups in the Silicon Valley that are about to go IPO. You hear about this a lot. That's a privately held corporation that's looking to be publicly held. Why would a private corporation want to go public? We can talk about that in detail, but it's because they want more liquidity. They want more cash. It's easier to get funding when you go public generally, but there's a lot more requirements held to a public entity than a private entity. So I could take my recording studio public if I follow certain requirements, and there's people who want to actually purchase it publicly. So the advantages of a corporation are this separate legal entity. Because as a separate legal entity, if something happens in the corporation, some kind of negligence that's not intentional from the owner itself, that illegal entity can get sued, but the owners are protected, right? Like if someone sues my recording studio, I can still keep my house. My house isn't in jeopardy. There's a legal protection there. which is that legal limited liability to stockholders. And it's easy for me to transfer ownership rights. If I want to bring on more investors, I just sell you some stock. I don't have to change my partnership agreement. I don't have to go through these complexities. I just say, hey, you want some of my stock? There's continuous life. If I die, I can just give my stock to anybody. I decide who my heir would be, they get their stock, right? It lives past its owners. Lack of mutual agency for the stockholders. I don't have to know the other stockholders in the business, right? Like it's just not, if in a partnership, generally you have to know the other partners because you hold some liability with each other. But in a corporation, I don't have to know. Like Michelle might be a owner of Apple stock. I could be an owner of Apple stock. We don't know, right? And that there's an advantage there because we don't have to worry about coordinating our efforts. And it's really easy for these companies to gain capital by this. You could just sell the stock publicly. The big disadvantage of this public corporation or a corporation is regulation. There's fees. Like having a corporation, you pay $500 a year in California just to keep your corporate privileges. If you go public, you have to get audited and you have to go through, get reviewed by the SEC, and you have quarterly reporting requirements, is which you have to hire a lot of accountants for. It gets very expensive to maintain a corporation. And then corporations get double taxed, right? Corporations can get taxed at the individual level and at the corporate level. So if I'm an owner of a company, right? Like I own Apple stock. Apple gets taxed. Their 15% tax rate or 10% or whatever it is now, it changes all the time. And then when I get a dividend from Apple, I get taxed personally as well. So there are these two taxes. All of these things, you can dive into a ton of detail. This is a survey level course, so I'm not going to go into too much detail here. But you'll eventually take a corporate taxation class if you stay in accounting, and you'll take a regulatory class, and you'll learn more about all of these nuances. And that's what makes accounting and business is very complex, right? Like any of these, you can become an expert on government regulation or taxation, corporate taxation. So how is a corporation organized? And what is the management structure for a corporation? There's actually really, I view it more as a circle. The pyramid's okay too. But stockholders elect a group of board of directors. So the board of directors manage the high level day-to-day of the business. So they make the big decisions. Really, their main goal, though, the board of directors, is to appoint management. So as a stockholder, like, as someone who bought Apple stock, I don't have the ability to manage Apple, right? That's a unique problem for a stockholder. If I was a partner of Apple, if I was a partner in a business, I generally have to be very involved in the business. As a stockholder, I don't want to be involved. But then how do I make sure the business does well? We appoint board of directors. And so you vote, or you generally have voting rights for the corporation, and that those voting rights are used to appoint their board of directors, including a chairman of a board, and they could be a variety of people on this board. And that board of directors hires a CEO, CFO, and the C-suite within a corporation, as well as president and vice presidents. And then these people run the day-to-day. The CEO, CFO, all those will start hiring employees, which work for the business, right? So as stockholders, we stay very minimally involved. We just appoint the board of directors, and the board of directors make sure management is staying up to snuff. And then they hire the employees that really do the day-to-day. You might hear of sometimes like a CEO. A CEO is also the chairman of the board. That's not an ideal structure, right? There's some conflict of interest there because they have too much power. Because if the CEO can also appoint all of the other C-suite, then the board really loses its influence. And so there's a big risk there. When you hear like the CEO is also the chair of the board, there's a really large power of influence there. Or if a majority stockholder is on the board and is also a CEO. This normally happens when the founder takes a company public. Like Steve Jobs is a good example if you go read into his story. If they have a vision, once it goes public, really the public starts to get some power. So this is really the corporate governance structure. You can see that this is much more complex than someone just owning a business, but it's also the reason why you can scale and purchase so many investments. There's a huge advantage to society by being able to structure businesses this way. And so here's just showing another example of what these people do. So stockholders control the corporation, normally meet annually to appoint the board of directors who have overall responsibility of managing the company, but they give the day-to-day to the president or the CEO. The board of directors, those are normally very senior level people, and they might meet quarterly or annually and get paid. I don't know the technical term, but probably I would call it buttloads of money. You meet for a day and they get hundreds of thousands of dollars to meet for that day. These are like experts. And as an accountant, if you become an auditing expert, they have to hire an auditor on your board of directors for these large companies on the audit committee. And they can meet for like 4 hours. They get flown out to a nice city and they can make $100,000 in that 4 hours. Like it's insane, the kind of compensation for being a board of director. But these are people who normally work 20 to 30 years and dedicated their lives to being an expert in some field. And so they sit on a board, maybe like 3 or 4 different boards, and advise and choose management. Rights of the stockholders. So what makes all of these parties different? Stockholders, we get to vote at stockholders meetings. We get to sell our stock, and we get the rights to dividend for those stocks. We can buy more shares of stock. And if the company liquidates, if it goes bankrupt, we get a share of what's ever remaining. Right? It's still our business. Like I own stock in Apple. If Apple ever goes bankrupt, I get to get some of Apple. Like I get some of their money, right? I'm an owner. On the old days, you get a stock certificate. It's not too old. Like I'm talking about 10 years ago, you get stock certificates. You could still get them today, but now you just track it online, right? They're just numbers online. The share is like your legal ownership in the business. So let's go back to accounting. That's the high level, what stock are, what corporations are. Bring it down to what does it mean from a business perspective? Well, we're curious. If I'm an owner, I want to know how much percentage I own in the business, right? Like if I own 50% of Apple, it's very different than owning 0.0001%. But shares, companies don't have to issue a set amount of shares. So companies can issue billions or trillions of shares, and I could own a fraction of a percent of a share. And that's what a lot of these companies do. Like Apple, we could look into how many shares they've issued. That might actually be interesting since we've been talking about it. Apple 10K, right? We've been talking about financial statements. That's our annual financial statement. We can look at, let's see, all filings. All filing for 8K. Let's look for 10K, annual report. Oh, and if you ever want something interesting, every public director has to give a proxy statement, which tells you their pay. So you can see that I'm not BSing about the pay. Let's see. These proxy statements. Let's see. Proxy statement, annual shareholder meeting. Let's see. So you can have more than enough reading if you're ever bored. You can read on how much these people make. And so here you can see these are the board of directors, right? The people that might meet quarterly. For those quarterly meetings, these people make $400,000 or $500,000 a year. Talking about like not active participation in the business, right? You can see this for any business. Executive see you also can see their pay here too, which is kind of interesting. Let's see. Where is it? Tim Cook, like 2020, made $14 million. Right. The chief CFO, just to show you, like accountants will become CFOs if you pursue this long enough. He made more than the CEO, right? That's how valuable this expertise is. $26 million. There's incredible amounts of money, right, that people make when you go to the high levels. And you can see it all in the proxy statements. But the 10K, we're talking about stock here. If we go to the financial statement schedules, let's find it. Apple is a very large one. Maybe we need it. We'll see how much stock they've actually issued. That's what we're looking for here. There you go. Note 12. So we're in the financial statements now. I know that because I've seen notes, right? We're talking about this, and you'll learn how to create these as we've talked about. And so in the balance sheet, it'll tell you how many shares are authorized and issued. So they have 50,400,000 shares authorized. That's how many shares they can actually sell to investors. Thing is, this is millions, right? But all of these numbers are in millions. So we're talking about trillions of shares, right? So it's an insane amount of shares that they're authorized to issue. That's what my point is getting at. But you'll see that there's this par value concept that we're going to get to. That's what they're saying here. Like they have 250 million shares. Some companies have billions. Some companies have trillions of shares that they're authorized to sell. Then there's issued and outstanding. So the amount of shares issued or sold to stockholders is the issued amount. And then outstanding is the amount that's currently outstanding in the market. So you'll see this, and then you'll see this concept of par value. We've talked about par value briefly before, but par value itself is just, in my view, an antiquated legal term where you can establish. When I made my recording studio, when I fill out the paperwork, it asks what par value do you associate with your business, and what do you value your business at the day of signing. And so you can make that number really any number you want. You're supposed to make it the number of, like, if your business is worth $100,000 and you issue 100,000 shares, you're supposed to make it $1 a share. But you can really make it anything you want. There's no real legal consequence. It's your business. And what that says is if your business liquidates, how much money you're legally entitled to give to your shareholders. But it's kind of this antiquated topic, and you'll see most companies have a very negligible par value. It'll be 0.000001 cent. However, we still have to account for it. So I'll be teaching you that in this class. So yeah, par value is an arbitrary amount assigned to each stock. That's what they mean. It's really arbitrary. I can assign anything amount. It's not equal to the market price. Right? Make sure you understand too, like this stock price is the issuance amount. It has nothing to do with what this current stock valuation is in the marketplace. It has nothing to do, completely separate topics. You issue a certain amount of stock in the public market, banks buy the stock, and then they sell it on the marketplace. That has nothing to do with how much money the company received, and that has nothing to do with the current value on the balance sheet. The balance sheet is a historical cost of when the shares are actually issued. There's a few different types of stock: par value, no par value, and stated value. I'm mainly going to test you on par value stock. That's the most common. I haven't seen the other in practice, but I'll let you know about them. And then we've talked about equity a lot, right? Equity is just retained earnings minus cumulative net income. And then if there's distributed dividends, we take it out as well. So I see some questions. Let me stop here. Okay. Any questions so far? It looks like it was more about attendance.
I'm sorry. I have a question.
Yeah.
Like until now, I am getting confused with shares and stocks. So like, what is the difference? Because there's a
Same thing.
stockholder and there's a shareholder also.
Same thing. They mean the same thing.
Oh, okay.
Yeah. Shareholder and stockholder are synonymous.
Okay, thank you.
Good question. Yeah. Any other questions? I like your questions. Keep them coming. I normally have to get questions from executives, so it's nice to get questions from students. So feel free to give me lowball questions, right? If you're interested in anything, please ask me. Now's the time to learn. So, okay.